fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We're going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Fear and fury, dilemma and dismay. Countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that appends decades of America's support to globalization and potentially has the power to disrupt and rearrange global trade. Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the big 5 takeaways. Trump announced what he called discounted reciprocal tariffs during a long, drawn-out speech at the White House lawn. Now, several countries, including the likes of China, Vietnam, EU, Japan and India, are staring at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per Trump administration, the rates were calculated as roughly half of what the US claims these countries impose on American exports. That's after factoring in tariffs as well as non-monetary barriers, among others. Now, India's Commerce Ministry says that it is carefully examining the implications. So what does this mean for India Inc.? Well, India's pharma sector can breathe easy as Trump's reciprocal tariffs strike exempts the sector. Meanwhile, IT and jewelry sectors, however, stare at a backlash from anger and outrage to emergency meetings. Trump's tariffs have evoked a slew of reactions across the world. China has called for Washington to immediately cancel the tariffs, warning that they endanger global economic development. The EU, meanwhile, is preparing a fresh package of countermeasures.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
Well, India's textile and electronics exports may get a leg up. This comes as competitors, the countries such as China, Vietnam, Indonesia, Bangladesh, could face relatively even higher US tariffs. Now, the pharma industry, meanwhile, has heaved a big sigh of relief after staying out of the tariff ambit. Hormaz Fatakia joins us. Hormaz, tell us, give us a pulse check of India Inc.
A fairly resilient reaction coming in from the Indian markets today, and considering how the start was supposed to pan out, you would take this session with both hands. But as the session went by, there was a very clear demarcation between the winners and the losers of Donald Trump's tariff announcements, the 27% reciprocal tariffs that were imposed on India. And Donald Trump mentioned that he had mentioned to PM Modi that although he's a very good friend, you don't treat us well, and hence we'll be charging you half of what you charge us, and hence the reciprocal tariff imposition. But one of the sectors that took a a beating in today's trade was IT, and it was the mid-cap IT stocks that took it on the chin in today's session, be it Persistent, Coforge or KPIT Tech, falling up to 10%. And it is not because of any tariff-related concerns, but because of this tariff imposition, the rising fears of a recession in the United States, which is a key market for these IT companies, is the result of why these stocks took a beating in today's session. Another sector that took a beating, we don't talk about that sector that much, were the shrimp exporters, and it was stocks like Avanti Feeds and Apex Frozen Foods that at one point were down almost 18% in today's trade. India, of course, is one of the largest shrimp exporting countries to the US, and Incred Research has analyzed that in case these tariffs remain in place, the shrimp import duty will now rise up to as high as 45%, so a negative reaction for these shrimp exporters as well. And some of the winners, though, in today's session, one very clear winner was the pharma sector, and it was the Nifty Pharma Index that was an outperformer today. Most of the stocks ending higher, although off the highs of the day, but still ending higher. The question only remains is for how long, because there are investigations that are in progress, and that leaves the window open for any future tariff levy on the pharma sector. And lastly, another winner that emerged in today's session was the garment and textile companies, be it the likes of Trident, be it the likes of Arvind, Gokaldas Exports, all of them seeing healthy gains in today's session. And that's not because they were exempt from any form of tariffs, but the competitive nations were the ones that were charged a lot more in comparison to India, be it China, be it Vietnam, be it Bangladesh. All of them charged anywhere between 40 to 50% in terms of reciprocal tariffs. So that gave India a competitive advantage, and that is why you saw healthy gains in these names. So clear winners and losers. It'll be interesting to see how this trend sustains from here on.
Right, Hurmaz, thanks a lot for that. Now, market experts believe that Trump's reciprocal tariffs on India could hurt the country's financial markets significantly. Speaking to CNBC-TV18, Axis Bank's chief economist Neelkanth Mishra maintained that while the impact on the Lal Street could be bad, the economy will be less impacted than other countries. Macquarie Capital's Sandeep Bhatia echoed the sentiment while adding that the duties will destroy global demand. Meanwhile, Samir Arora of Helios Capital said that the Indian market could be hit if Wall Street witnesses declines of over 10%.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. It's only through higher inflation that tariffs actually become effective on what the US government is trying to do. So, but the US government will have some tools to provide some solace, some assumption, some comfort to the US consumer through some other tax cuts. But the gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production could be another 1%. I think we are talking about a significant rise in uncertainty for financial markets.
Neelkanth, sorry, just to get those figures in, 1% hit to 1% hit to US GDP, right? Or global GDP?
Global.
1% hit to global GDP, which
because of postponement of investments.
Okay.
In addition to what is actually a 0.6% of global GDP tax that the US is now collecting. I don't think it is possible to quantify the impact of non-tariff barriers very efficiently. So some of the speculation on how this may have been calculated is right. But remember that the objectives remain the same, which we had discussed the last time. Multilateralism is over. The US does not want to get hollowed out industrially. And the dollar they want to depreciate, though I don't think this is going to help. And thirdly, that they want to generate out of revenue out of imports. So all of those three objectives are what I think we should solve for.
So for someone sitting here in India and watching all this, a very simple question. Should we feel slightly relieved because we're not as badly impacted as a lot of the Asian exporters, export-facing economies? Or is there a lot of reason to worry because of the second and third order effects? What you said, 1% being shaved off global growth itself, which eventually will come back to hit us as well.
I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope thing. And in addition to the 0.6%.
In addition, so it's 1.6%, yeah. Overall impact on the global economy. Yeah.
So,
Overall impact.
in addition to the 0.6% volatility that 1.6% of volatility that
Yeah. 1.6%. Yeah. Overall impact on the global economy.
Exactly, which is at the first shot, right? And so now we have to see second order, third order effect. So this is not going to help anyone. We are slightly less affected directly, and remember that many of the problems that we had self-inflicted on ourselves, we are starting to solve them. Like the liquidity side, I think the RBI has been very proactive and it has shown a lot of action after stating its intent, and therefore the liquidity premium that existed, which was very significant and which was actually slowing down the economy, is now very quickly getting whittled away. So the domestic economy actually should be on a better footing for its internal demand. So India economically, I think, will be less affected, but the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time. The Fed put that the markets had become addicted to over the last 3 decades, that whenever there is a problem, the Fed can cut interest rates and the things will get sorted out. This time, it is a much, much more complex problem. While we are less affected because of this, in fact, the gap, as I said, between MFN rates and what has been imposed is perhaps India is much better off. Second, we are less exposed to global trade on the good side than we have than many other countries. And thirdly, our own economic headwinds that we had created for ourselves are now starting to ease. So economically, I think we'll be fine, but I think the financial markets, the currency markets, I think are going to get badly affected.
President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this.
The real challenge actually is not directly to India, but the entire political economic system and order is being overturned as we see. The real impact, therefore, on India will be the demand destruction that will happen globally. I think people will be very simplistic to assume that this is my exports and this is my direct impact. But remember that tariffs are going up not only for India, but tariffs are going up for other countries. And a lot of other countries around the world are significantly more globally dependent on exports to the US than India is. I would think that right now is a risk-off moment. So to say that foreign flows will be rushing into India because of that, no. But yes, India will be least impacted of all the emerging markets. That much I can definitely see.
The first thing in a big picture sense, although, in our long only fund, we are fully invested and all that. But I would think this behavior of the market is a bit suspicious and not to be trusted because, Indian market has made this simple thumb rule, not that they will analyze the stock, but whether that day there is net selling or not by FIIs. See, the thing is from an economy point of view, it's not a big deal because we don't have big scale of imports and exports. You have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it and maybe not be up in that period, but at least it will be dignified and you will get FI flows. But if the US market is down, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money. You may lose less. You may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US.
Well, with that, it's time now for a short break, but we continue our special coverage on Trump tariff and its impact on the other side. Welcome back to our special broadcast. Now, former diplomat and fellow at the Center for Social and Economic Progress, Jamini Bhagwati, fears that Trump's tariffs is set to impact movement of FDI globally. Further, called out US for being short-sighted as it imposed hefty tariffs on its trading partners. Meanwhile, former Finance Secretary SC Garg doesn't see any reason why India needs to be protectionist and consider cutting down on tariffs on auto imports. On the contrary, former chairman of Central Board of Excise and Customs says that auto sector has reached maturity in India and can look at reduction in rates. He added that India must approach free trade agreements cautiously.
They're looking at exports divided by imports and then divide that by 2 to come up with a tariff rate, which is simplistic to say the least. But let's take a step back. You know, these tariffs are a part of an overall Trump agenda. And this will have consequences in the short, in the medium, and long term around the world. And it will not just be confined to trade, it will be more widespread in terms of foreign direct investment.
So do you believe that as India readies its response, where do you believe we should draw the red lines and what more do you believe we can offer?
You know, there's too much has been made about this trade agreement that we'll sign by fall or by December and so on. There is tremendous resistance over the decades, I've noticed, from our industry to opening up our trade sector in goods. And, they're right. The US is right that we have irresponsibly high trade barriers. For instance, certain kinds of car above a certain engine size, 125% duty. We have only heard of Harley Davidson from him. Why is Indian industry so scared of competition? Or is it that they are so mollycoddled and feel so comfortable? I'm not suggesting that what Trump is doing is reasonable or right or not. But I'm talking about a spin-off benefit that if it forces our industry and manufacturing to be a little more competitive.
Yes, you're right in pointing out that neither of us are business people, and yes, the consumer will eventually benefit if we actually see lower cost imports coming in, which may force Indian industry to be far more competitive as well. But, I also want to understand from you, Mr. Bhagwati, how we should read what is happening within the region. Now, we've already started to see industry reactions coming in saying, look, while there is a cause for concern, but we should also look at the silver lining, which is that China, Vietnam, etc., have been slapped with higher tariffs in comparison to India. Now, do you believe that this kind of response at this point in time is premature? How do you believe this is going to reshape what has been happening in the region when it comes to FDI, when it comes to supply chain resilience?
Highly premature, because it's not just duties. Shireen, I'm sure you will not buy a product that you're not satisfied about just because it's a little cheaper. So in case these duties mean that some manufacturing moves to India, so we need to be careful that we have the robust supply chain in place and so on, which will take time. My guess is in the short term, I think the US and President Trump in particular have been short-sighted in imposing such huge tariffs on ASEAN, the smaller ASEAN countries. They are basically providing relatively labor-intensive products to the US. What is going to happen? Here is where I bring the strategic aspect into play. The ASEAN countries are physically closer to China. They have large volumes of trade with China, but they are strategically closer to the US because they don't want communism to overtake their countries, except for Laos, which has now effectively become a Chinese colony, and Cambodia is also hugely under Chinese influence. But even somewhat larger ASEAN countries like Malaysia, etc., Thailand, they may gravitate towards China in terms of looking for ways in which they can meet market demand in China on some preferential basis. And the Chinese, given the size of their economy, will look to provide some kind of alternative to the US. So that is more likely than India immediately replacing Vietnam or a Malaysia or Thailand as a place where manufacturing will quickly shift. It could over time, as we know in the case of Apple. We are now producing Apple phones because that's also somewhat political in terms of the summit level meetings between India and the US. And I don't see that we will become a world leader in terms of a trading nation. If we had that confidence, we would have joined RCEP because we were nervous about our own capabilities, or the CPTPP. I think those are groupings that we should have a fresh look at. We don't have to do it in public view. This can be done quietly by experts within government and also pulling in non-government experts to look at the change scenario. Do we still feel that nervous about these trade blocs as compared to earlier, given the kind of attitude that the US has taken yesterday?
Times ahead, difficult times ahead. What I had mentioned in that article was basically the NITI Aayog study itself, which pointed out that India's exports under the FTA to ASEAN countries specifically had not really shown the sort of export benefits which we anticipated when we went into the FTA. So one was only telling that you go to FTAs with caution. And currently, the silver lining, apart from everything else, the other countries being impacted with higher tariffs, is that pharma is not there. Textiles are another area of strength for us. Bangladesh and Vietnam seem to be having a higher tariff as of now. But there's a great amount of uncertainty. And I don't think this helps business, this helps trade, this helps the Indian exporters. He'll have to factor how much pain he will absorb.
Mr. Garg, come in here on this discussion. Your first thoughts, sir, impact and what can we do? Mr. Shah earlier said FTA is, of course, work in progress, but we need to enter those cautiously and carefully because we have data which shows they don't, outshine growth otherwise. I mean, FTAs by themselves. Go on, sir.
India cannot simply look at that bilaterally, goods by goods or sector by sector we'll negotiate. I don't think Americans have patience and the time to do these bilateral negotiations. We'll have to also see whether we can take broad brush calls. And here, again, if you analyze the Indian basket of exports to America and American exports to us, I don't think we need to have such high tariffs at all, whether it's agriculture or whether it's industry. So slash the tariffs down massively. The Indian industry might suffer some short term, but Indian consumer will not suffer at all. I think the time has come to join in this it's big reordering of the world trade and the economy which is happening.
And you're saying India needs to have a far wide-reaching sort of thought to this. But if India were to start opening up, in sync with what the US wants, this could be pretty damaging for domestic industry, wouldn't it?
Automobiles, which you just said. In automobiles 20 years, 30 years back, we perhaps needed some protection. But today, compare the prices of a Tesla being manufactured in America or Tesla being manufactured here. It makes hardly any difference in cost because so much of automation, robotics and other things have taken place that in automobiles, the labor advantage is completely gone. Even today, in EVs, etc., many of the components, engines and others, you are in any case importing. So I don't really see any threat if you reduce the 60% tariff to 10% on automobiles. I think we need to get out of this unnecessarily overprotective mindset. It's not required any longer. Why should American almonds or apples have a higher tariff than Afghanistan or Iranian almonds? What is the problem if we have the same tariff?
Mr. Shah wants to come in, I think. He's shaking his head. Mr. Shah?
No. The rates of, we don't have any US-specific tariffs, Subhash. All our tariffs are MFN, except where we have a FTA, which is WTO compliant. and which permits us to have this reduced tariffs in respect of those countries with whom we have a free trade agreement. Otherwise, the tariffs are common across the board. So if you're going to reduce tariffs for any product which is coming in from America, it'll apply across the board for all imports coming in from all countries, which is the principle of MFN, as you are more than aware. So I think auto sector specifically is a sector which, because of protection, has gotten investment into the country, and we are an export country now. Hyundai and Nissan and Volkswagen, everybody exports from India. So I think auto sector has reached maturity, Mr. Subhash Garg, and that perhaps you can look at some reductions.
Yeah.
You know, I want to sort of take out the silver lining in all this.
Yeah.
Perhaps, and gentlemen, weigh in on this. Perhaps they started with, calling out this tariff war, and somewhere down the road they realize that what's more important is not tariff but overall trade imbalance, which can still be addressed. You know, it depends on I import some from you, you import some from me, and therefore there is a trade surplus or deficit. So perhaps if that is the way the US is thinking, then that does open up room for more negotiation, for protecting, India's interests versus maybe giving in to some American, pressure points like bourbon whiskey and, like of course, the Harley Davidsons. Mr. Garg, you coming in?
I just wanted to say one more thing. See, the days of FTAs, bilateral negotiations, regional negotiations are all gone now. With this kind of thing coming in and the world becoming a one single manufacturing global entity itself, the national manufacturing, etc., and in a situation where there is a global surplus of supply of industrial goods now, the time has come to virtually do a very fresh thinking on the entire tariff structure. Maybe like domestic economies, we have abolished the duties on interstate kind of thing. Globally now, the time has come to do away with all tariffs everywhere.
And with that, it's a wrap on this special broadcast. Thank you so much for watching. News and updates will continue right here.